Hi, Evan Nielsen here with Nielsen Law Group. Our topic for this segment is probably one of your favorites, how to avoid a tax audit. We've been involved in lots of audits, and although many of them are resolved in favor of the taxpayer, I've never had anybody say after the audit was done, wow, that was fun, let's do that again. So our subject is just simply some basic things, 6 in particular, that you can do in order to avoid a tax audit, or at least minimize your chances of being selected. A little bit of background to start with. The basic statistics change each year, but for 2013 and surrounding years, individuals who made $200,000 or less filed approximately 130 to 140 million returns. Of those, 300,000 were selected for what are referred to as field audits, or where an examiner actually wants to visit with you and see your records. Another about 1.1 million of those taxpayers received what are referred to as correspondence audits. That's where there's a specific question and the IRS is asking for information via correspondence and expects a response via correspondence, and in some cases a phone call, about the verification or the proof of the claim that you made on your tax return. So if you add those numbers all together, that's about 1%, or 1 in 100 taxpayers. Remember, that's in the income category of $200,000 or less. Now, when you go above that, if you're earning more than $200,000, then your chance of an audit goes up to 1 in 8. That's almost 13%, so it is substantially higher. The more you earn, the more likely you are to see an audit. Now, if you're an international or a foreign income earner, then your chance of an audit, no matter what your income category is about 6%, so also higher than the norm. What that all means is that there is a reasonable chance that someone is going to be audited. And when those audits occur, they always surround the question of information that's on your return that the IRS can't verify. So think of it this way: if there's income that you've earned during the year from your employer that's reported to you on a W-2, that same information is going to be reported to the IRS. So when you put it on your tax return and send the tax return to the IRS already has the information and can match that information up. But other information on your tax return that you're reporting may not have been reported to the IRS. So for that reason, they want to somehow verify it. And the only way to do that is either through a correspondence or a field audit. So let's talk about now the things that you can do to minimize the chance of an audit. Some of them have to do with the verification of information, and others just simply have to do with making sure that your tax return is prepared properly. So let's start with some of the basic things. If you receive any type of information that is also reported to the IRS, make sure that it's reflected on your tax return. If you receive a W-2, report it on your tax return. If you receive 1099 income of any kind, make sure that that's reported on your tax return. Those forms that go to the IRS that indicate that you received income are the things that they're expecting to see on your return. So make sure that they're there. Now, that doesn't necessarily mean that you're going to have to pay tax on them, because there's a lot of deductions that you can take as well. But you want to make sure that anything they have is also on your return so that your information matches with theirs. Second item, make sure that the basic Social Security numbers are accurate on your return. Yourself, if you're married, your spouse, and then if you have dependents, that their Social Security numbers are also accurate on the tax return. If you have adult children who you're claiming on your return, make sure that they're not claiming themselves and that they have indicated they can be claimed by someone else on their return. Otherwise, that will create confusion with the IRS's records, and you may hear back from them about it, asking for clarification. A third area, which you might assume would be so obvious that we wouldn't have to mention it, but you'd be surprised how often this comes up. And that is to make sure that the math is correct on your tax return. when you add the numbers together to come up with totals, make sure that those numbers are done properly from a math standpoint. And this is especially important if you don't use some kind of software program or a tax professional to add your return information together. About 20% of the correspondence audits that the IRS pursues, they indicate, are generated by math errors on tax returns. So be careful in this area. So those are three things that you can do from an administrative or clerical standpoint to help reduce the chance of an audit. Now let's talk about three things you can do that are a little more strategic in nature. The first one, every year the IRS collects tax information, and as part of the Department of Treasury, they then summarize it, and usually 18 to 24 months later they provide that information in summary form to the general public. And that's all available on the Department of Treasury's website under their various forms and publications. Among those things that they summarize are the averages that they are expecting in every category. So if you have an automobile expense on your tax return, you can go to those documents that the Department of Treasury provides to see if you're claiming more or less than the IRS is expecting. If you're in a particular industry, on your business return, you can go to the IRS information that's on the Department of Treasury's website to determine approximately what amount of expense percent each of those categories that you're claiming are compared to what they would expect based on the overall averages for that industry. So those represent the standards that the IRS is expecting when they see information. And if the information you're providing on your return is substantially higher than the average that the IRS has seen in the past, there is a good chance that they will ask questions about it. So look at those standards and compare your figures to make sure that they are accurate. We often talk about the fact that it's rare that an audit can't be won because you have the documentation and you have the right to claim it. But winning an audit is rarely considered a win because of the emotional pain that it takes when you're going through the process, the amount of time, and then usually the amount of expense as well. So better to avoid the audit than have to go through it. And if your claim is higher than the standard, you may want to consider reducing the amount of your claim, just so that it brings it back into line with what the IRS is expecting. Now, something that's related to this, there are some specific areas, particularly on a personal tax return, that are referred to as suspect entries or suspect forms. These are the things that the IRS doesn't have the ability to verify based on the information they've already received. One really good example of this is a Schedule C, where you report business income and expense. Almost everything on this return is unknown to the IRS until you tell them. They may get 1099s from someone else telling them how much income you received, but they won't get anything from anyone else about the expenses. And so whatever you claim on that Schedule C is going to be suspect. If you have business income and expenses, or just business expenses, give serious consideration to establishing a business entity and claiming those deductions there instead of using a Schedule C on your personal return. Another really good example is a Schedule E, rental income and expense. Usually the IRS has no information at all about rental income and very little information about rental expense, with the possible exception of a mortgage where the lender has reported the interest expense to the IRS as well as to you on Form 1098. But this is another example where you should give serious consideration to putting that information on a business return, where it's treated completely differently and where the audit risks are also substantially different. Those two are examples of forms that are suspect and can, just because you have one, give rise to an audit. Some entries are suspect as well. Business use of a primary residence, business use of an automobile. Those kinds of things can also, because they're unknown to the IRS in terms of the exact data, give rise to an audit. So be very careful about using those suspect entries. And I'm not suggesting that you don't take them, but that you take them on a business return instead of on your personal return. And the last item then obviously is to use a business return wherever possible when it comes to taking any kind of business expenses, and avoid the use of business entries on your personal return if you can. So those 6 things: make sure you report all of the information on the forms you receive, make sure the Social Security numbers are correct, make sure the math is right, compare the information to the IRS standards, avoid suspect forms and entries, and use a business return. Now keep in mind, as I mentioned at the beginning, somebody's going to be audited. The IRS, even though they're experiencing budget pressures and having to reallocate resources, that's resulted in a reduced number of audits, they're still going to audit some returns. And so what you're trying to do is minimize your chance of being audited, and the best way to do that is to eliminate any possible questions that could arise on your return. So make sure the information is accurate, make sure that it is complete, and make sure that whatever you're reporting, the IRS already has, and your chances of being audited will be substantially reduced. Hope that's helpful. We encourage you to give serious thought to the things I've mentioned, and if you have any questions, please feel free to contact us. Thanks.